So we left off with our knowledge that there are only 13 bars the market can give you. There are variations of these bars, okay? So when we talk about bar 1, the solid green bar, you can have a little tail at the top, a little tail at the bottom. As long as the vast majority of the bar is green, that's bar number 1. Okay, as long as the vast majority of the entire elongated bar is red, you can have a little tail at the top, little tail at the bottom, or whatever, but that's bar number 6. So there are variations, but there are only 13 bars. Okay? And knowing what each bar statistically is likely to produce, the directional bias that each bar is a big part of the game. A lot of people get caught up on the notion that you need to read a lot of former newspapers. Yesterday's bar is yesterday's news. The last 5 minutes is gone. All right? Now, I hate to wax too philosophical, but there's a train of thought that time is man-made. Time is psychologically man-made. It does not really exist. There's always just now. Okay, we only have now. All right, yesterday was a former now. Tomorrow's a future now, but it's always now. All right, so the concept of time is flimsy. The concept of time is man-made. When we apply a portion of that thinking to the markets, things become clearer to us. The stoppages of your bars, and then the start of the bar, that stop is an artificial stop. There is no stop. Okay? There's just a constant flow of ticks. And trading is sort of just riding the waves. If you can see beyond the lines, and you can see that when a bar was solid green, then loses 55% of its green, then the next bar drops and produces red, that if we put them together, that's one straight move down with no hesitation, no interruption. So when we see beyond the divisional lines, we see the markets deeper. So there are 13 bars. We have gone over what the statistical likelihood of the bias is after each one of the 13 bars. We have isolated the bars that we need more information on, right? The neutral bars. And that makes part of our game. I then taught you that once you experience, if you get a nice, decent green bar that loses more than half of its green, you can short right there with a stop above the high, right? In anticipation of the next bar being a drop. You can, if you get a nice, decent, solid red bar that loses more than half of its red, you can go long before the bar finishes. I am not a believer in waiting for the bar to finish. You do it as soon as it happens. There could be a lot more time left in the bar. Who cares? That's what stops are for. There's stops underneath the low. You're buying into the bar before it is complete with a stop under the low. If you have bought a 55% retracement of a red bar, 55% retracement of a red bar, and you have entered, then it goes to 100% wipe out of the red. What are you doing? Adding, double up. Okay? Must happen on the same move. Okay? And if it keeps going, what is your thought process then to produce the opposite color? Right. Think about this. So it was red, a red bar. More than half of the red got erased. You buy. Now all the red gets erased. You enter more. Then it goes green. Your thought process is, I have found the final low forever. Now that's not true, but that low is in place in your mind for a long time. Statistically, you're right. And it is not a play to be anxious and scared and this and that. This, you have got the move. You've got it. You should relax and let this thing just rock to great gains. When that happens, when that event happens, that's a 180-degree abrupt, powerful turn. Those only happen because the other side just becomes enormous. Okay? So now let me show you. So we've talked about how bars lose, how red bars lose, and how green bars lose in one bar. Let's talk about how it happens in two bars. See, 2 bars is really 1 bar in a bigger time frame. It's 2 bars in a smaller time frame, but you have to be able to visually see that as well. So here's how that event happens in 1 bar. We have full control. Each bar here represents solid, decent control by the bulls, solid, decent control by the bears, as long as they maintain more than half. As long as they don't lose more than half of the color, they're in control. Odds are follow through to the upside 80% of the time. Odds of follow through to the downside 80% of the time. Okay? Here, the next bar opens and starts trading, and it starts eating through the former bar's greenness. And this bar opens and starts eating through, retracing a portion of the former bar's redness. The assumption is that bulls are still in control because the bears have not dropped it all the way down to wipe out more than half yet. All right? But so everything is still okay with the bulls right now. Everything is still okay with the bears. On the current bar, that's bearish, but it's mild bearishness that is acceptable bearishness as long as the previous bar's green is maintained. This is where the previous bar comes into play. And the same here. But here, this one is weak control. Theoretically, the bulls still have the dominant, they still have the control. Why? The 55% level has not been violated yet, but it's shaky. It's shaky. Bears still are holding on control by their fingernails. They still have it by definition, but it's shaky. And here is lost control. When you get a 2-bar event, solid green, next bar wipes out more than half of the green. Bears have just taken control of the stock. That's a short opportunity. You can enter short right here with the stop where? Always above the or below the bar you dive into. That's the reason you short it. So you would never want your reason to disappear. And your reason would disappear if the high was taken out. So I short with a stop right above the high of the bar I dove into. Here, I'm going long before that bar finishes. A lot of people say, well, Oliver, isn't that too risky? I'm buying it. I'm not certain it's going to stay green. That's what stops are for. 20% of the time, that bar will not stay green. 80% of the time, it's going to shoot you forward into more profitability. It's an 80-20 game. Do your job and handle the 20% that fail. The market will handle the 80%. Okay? Your job is to be a murderer of your plays, an eliminator, all right, of any 20% time that happens. Yes, sir.
Either you or Greg Kapler, one of the folks, was saying this is congestion, and wait now, it's more than 30% into the previous bar.
Congestion is more this. This is penetration. And I want you to remember this. The numerical number for change is 55%. That's the numerical definition of change. Okay? 55% erasure of a former event, change. Now, if you're short here and long there, what are you doing? Well, what this slide shows is that the bar was here. In reality, this event is exactly the same as the 1 bar event. This bar, what's happening in pieces, is happening, if this is a 1-minute bar, the next minute is wiping out. But if I made that 2 minutes, it would be 1 bar, right? It would be a 1 bar wipeout. Is there any difference? No. One's delayed and one's not delayed, but the same event. It's like a movie. One is on fast forward and one is on regular speed. Maybe another's on slow motion, but the same scene, the same event, the same characters, the same words. It doesn't matter to me if the 55 happens in 1 bar or the 55 happens the next bar. To me, that's the same event, because the divisional lines are a mental trick. They don't really exist in the markets. So it's the same event that has the same power. Move that over on top of each other, and this is what you have. We have a red move, a down move, was more powerful than the up move, making this bearish. The up move covered more distance than the down move at this particular point, making that bullish. And let me show you the next slide, which is very important. All of this is the same as that. This just happened, 55% happened a little faster than this 55% event. But they're both the same. I see them the same. This 55% retracement of a red bar is no different from this 55% retracement of a red bar. One is just a little bit more delayed. It spilled over into the next time period, which you created in the first place. An up move is an up move is an up move. Whether the up move spreads past your time zone or whether it happens within your time zone, it's an up move, it's an up move, it's an up move, and vice versa. Okay? So, what are you doing now? Doubling up, right? You entered at the 55% retracement of a green bar. You entered your first short. If the same bar reaches 100%, you've got to double down. This is extra powerful. The move is going to statistically be extra strong. Make it count. Yes, sir.
Let's say the bar before the green one showed you to get in.
Okay.
So we're in on the long green bar.
Yep.
So we're unloading when it gets past 55 and turning around, we're selling and then buying immediately.
You could. Now, this is going to become a little clearer because I haven't really added trend analysis yet. And that's next, where the trend is going to filter out one side of it so that you only take the longs in the right direction. You ignore the signals that say short and vice versa. And we're going to tighten this up for you, and it's going to be a beautiful system. A big part of this game is getting this right. Which way is the wind blowing? Okay, that way, or if that way is going long, I only take the long signals. If the wind's going this way, I only take the short signals. But I'm teaching you what the signals are first. Okay? Now, you have gone long, 55% retracement here. This could have stopped and the next bar started and you would have never doubled. But you got the 100% mark on the same bar. That's the caveat. If the 100% wipeout happens on the same bar, that's the only time you double down. That's the only time you buy it again. Okay? So let's summarize what the entry triggers are. Okay? We're going to summarize what the entry triggers are. The single bar triggers are when you have a nice, decent green bar that loses 55% of its greenness. You're going to short at the 55%. You will not wait for that bar to finish trading. You're going to short right now. You're going to place a stop right here. If this continues to lose green after you have shorted it and you reach the 100%, you're going to add to your short. Must happen on the same bar. Here is your, this got a little displaced here. Here is your, this was solid red. If a nice solid red bar loses 55% or more of its redness, you're going to buy into this bar before it finishes trading. I do not like waiters for bars to finish. I don't like that, because what if the bar finishes up here? You've just missed the move. Not only that, by buying before the bar finishes, you're closer to what? Your stop. It's actually less risky to not wait. Okay? Now, if you've entered your stop, this is actually misplaced. The stop should be just under the low. If on the same move you get to 100% of the red being wiped out, you're going to add to your long play, keeping your stop at the low. Okay? If this bar were to keep shooting higher, leaving you and your current price is so far above your stop, you must adjust it what percentage back up? 55. So it would move from the low of 100 to then 55% of the move back up. In your mind, the move up is green underneath. Where's the halfway mark?
I just had a question. So when you do double up, what happens to your stop? Do you just double the size of the stop, or do you move the stop?
I would keep the stop the same until the bar. This is an excellent question. When I'm doubling up, do I adjust my stop? If this move here makes that stop too far away for your trading guidelines, and everyone's got different ones, then you would go 55%. At some point, if the bar gets really long, it would be dumb to lose the whole bar. So then 55% becomes your new stop. Now, a lot of traders say, well, Oliver, okay, give me specifics. When do I do that? I can't really give you specifics because all of this has to be based on your trading plan. For instance, let's say you've decided that for my trading plan, I'm gonna lose no more than $400 on any trade. Well, okay, that has to be incorporated into the plays you take. If your plan is I can only lose $400 on any given trade, and I buy here and the stop would give me a $500 loss, that's either not your play, even though it's the right play, it's not the play for your trading plan, or you shrink your size, right? So depending on what your plan is, depending on what your game plan is, what your trading plan is will determine often when and where, what plays you take, and when and where do you move your stop to. But I'm telling you that if you use the 100 or 55% levels as your main bar-by-bar stop method, you're going to be okay. Your stops are normally placed at the moment something has changed. What place on the chart represents a change? That's where you place your stop. I've rarely been in favor of just arbitrary stops. To me, that's the market doesn't know your arbitrary stops. I like my stops based on what has changed. Where does change happen? Yes, sir.
On these triggers, if you're using micro time frames, are you talking about going in market orders or limit?
Okay, the question was if we're talking micro time frames, and we can be. Time doesn't matter to me. So this could be daily bars, weekly bars, monthly bars. You want to know when the market has bottomed? Wait for a monthly red bar to have a 55% retracement. And there you go. Or it could be 1 minute bars. All right? Time doesn't matter. These concepts are universal across any time. Okay? Now, the question was, if it's micro time frames, what's that last part?
Limit or market.
Limit orders or market orders. All right? I'm a limit order trader, but I'm a very rapid trader shooting multiple buys. When I buy, the buys are multiple lots. Like there's an explosion of buy orders. All right? So I'm not a one button buyer. To me, when I want a stock, there's never a thought of, I want 2,000 shares. Oh, on this one, I want 1,000 shares. While that's necessary for some traders, when a trader gets to a certain level of development, the concept of share size changes. It drops. You never limit what you can take advantage of. So my thought process is I will take whatever is available, whatever I can get in that area, I'm taking it. That might be 4,000, it might be 40,000. Why, if you have reached a certain level of accuracy, why would you ever want to limit your potential gain? Oh, I only want to make money on 1,000 shares on this one. Why not, if it's going to work, why not get 4,000 or 8,000 or 10,000 if you're able to do that? So the concept of share size changes for me. So at these 55% levels, I'm just buys, just multiple buys hitting the market. Now, there's only a certain number of shares available in that price zone or area. So I'm racing to grab them before anyone else if I can. And obviously, when all the shares in that price area, maybe it's a 2 or 3 cent price area, is gone, of course, they've left I've gotten filled on some, I didn't get filled on a lot, those get canceled, and now the stock's on its way. So I tend to be limit order because I'm able to be there and cancel it or what have you. Today, I used to say never place a market order. Today, spreads have gotten so tighter. If you're playing stocks that are extraordinarily liquid or what have you, market orders are okay. All right, market orders are okay. So it's really a personal preference. If you are not playing something that is extraordinarily active and very liquid, then you definitely want to do limit orders. You definitely want to do limit orders. You don't want the stock to carry you multiple levels higher, then get you filled. All right, guys, here's the 2-bar triggers. 55% of the prior green bar was wiped out. Short, stop above the entry bar. At the 100% mark, you're adding to the short. 55% of the red bar was erased, you're going long. If the same bar gets you to 100%, you're doubling up. Stop below the low. If that bar continues to grow, you're going to move your stop up to the 55% level. And on and on. Okay? So we've got the entries down. With nothing else, this will work. With nothing else. With no directional bias, with nothing. You could literally pick a time frame and just wait for 55% and 100% retracements and go. 80% of the time, you're going to be right in the direction of with the next bar. 20% of the time, you'll just have to be an eliminator of your stock. And that's the most important part of this equation. A lot of traders, I get resumes per hour from people who want to basically become a trader. Everyone wants to show me their winning trades. I don't want to see winning trades. All right? I'm more concerned with who you become when everything you planned does not work. What type of trader are you at that moment? When the lights go out and everything you thought was going to happen doesn't happen, do you freeze? Do you lose it? Do you go into shock? Do you play ostrich? Or do you rise to the occasion and act with a level of certainty as if it went right? To me, that is the mirror that you should be looking in to see what kind of reflection comes back. That's who you are. The market is like a mirror that shows us who we are, but we don't get the correct reflection through our wins. It's through our losing trades. And so that's what I want to see. When I told you earlier, when we were looking at the gains of traders, we were looking at how they lost in comparison to how they won. To me, that's far more important. That far more pinpoints a more accurate way, what level of trader are they? Do they allow their weeds to kill all their roses? Or are they a whacker of weeds the moment they rear their ugly heads? Right? That's the key. Hey. So now let's talk about location. In the real estate world, we're told that there are 3 major laws for assured wealth in the real estate market. And what are they? Location, location, location. Well, I will tell you that it's not far off in the stock market or in any financial market at all. Location is key. What I've taught you with the 55% and the 100%, what I'm about to tell you is that when these events happen at the right location, the odds get better. So now I'm going to tell you that every 55% is not yours. Only the ones that happen at the right location are yours. Every 100% is not yours. Only the 100% that happens at the right location. So let's refine this a little bit more and make it better. My location, the location items I will share with you today, there are 8 location items that I teach. I will share 3 of them with you. All right, there are actually 9. All right, but I will share 3 of them with you today. And these are powerful locations. There are 3 major moving averages, 3 moving averages. There's the 8-period simple moving average. That's a location item, a location spot on your chart. The 20-period simple moving average and the 200. These are the 3 location items, or the 3 items you should have on every single chart you look at. They will represent spots or areas on your chart that you'll be focused on in a very intent way. Okay? Now, I'm sure you guys know what this is, but all a moving average is nothing fancy about a moving average. It's simply the average price over X number of periods. So when you see the 8-period moving average, you're looking at the stock's average price over the last 8 bars. Average price over the last 20 bars, average price over the last 200 bars. Moving averages are just price looked at in a different way, in an average type way. Now, the 8 is best when it's trending up or down. The 20 is best when it's trending up or down. The 200 is the most powerful when it's flat. Okay, let's talk about these for a second. The concept goes like this. If my 8 and my 20-period moving average, but preferably if my 8 and 20-period moving average are rising, I am only going to take long plays in my stock. I'm going to ignore every sell trigger. I'm only going to focus on the 55% retracements on the long side or the 100% retracements on the long side. So rising 8, rising 20, I'm going long. Declining 8, declining 20, I'm going short. Now, if the 8 and 20 are rising, I'm going to look for 55% retracements of red bars at either the 8 or at or near the 20 or at or near the flat 200. These are the only 3 spots you are allowed to actually take one of these entry events. A red bar that is retracing 55% must happen at or near that moving average, an 8 or 20. If it goes through the 8 and doesn't happen at the 8, maybe as it drops to the 20, you get a 55% retracement. If it goes through the 20 and reaches all the way down to the 200, perhaps you get it there. If you don't get it, you just don't take it. But you can only take the event at the 8, at the 20, or at the 200. That's it. All other 55% or 100% retracements mean nothing. In order to short, I must have a green bar forming at or near this declining moving average, either an 8 or a 20, and a red bar must wipe it out or wipe 55% of it out. I'm only allowed to take that short event at or near the declining 8, at or near the declining 20, or right under, at or near a flat 200. So let's take a look at this. Here is a red bar right at a rising 8 or 20. Whichever one doesn't matter to me. Okay? Here's a red bar forming at or near a flat 200. Here's now 55% retracement of a red bar occurred near one of my rising moving averages. Now I'm going long. My stop is under the low. Here, the 55% retracement of a red bar happened right above a flat 200. Beautiful, powerful. Here, my green bar was formed right under a declining 8 or 20, lost 55%. Now I'm going short, stop above the high. Here is a scenario where the green bar formed just under my flat 200 and then lost 55%. I'm going short. You limit those events to these 3 locations, 8, 20, 200, and you're golden. Yes, sir.
Second question. I assume you're using the closing price for your moving averages.
Yes, good question. Yes, closing prices. I'm using the closing price for my moving averages, and the moving averages are simple. Right? Remember, guys, these are just areas, okay? Some people say, Oliver, why not exponential, why not triangular, why not weighted, or whatever? I've just found no evidence that they're any more superior. And it's a general area anyway that we're trying to get to. So the specifics aren't necessary. Guys, if you get 100%, you know you're adding. Adding, adding, adding to my short, adding to my short. Now, these are extraordinarily powerful. Had you played the market like this even over the last several weeks, would be enormous for you. The move up, the huge rally up off the low in many stocks in the market itself rallied right back to the declining 20. 55% of the green bar got wiped out, and then the bottom fell out again, right? This is very, 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 very powerful things. I'm going to show you a variety of charts where we see this working, because all of these have been stick figure stuff up until this point, but I am going to demonstrate it for you on charts. Here's the dual bar triggers. Remember, you looked at the same bar giving you your event. This one, the next bar gives you your entry, right? The next bar gives you your 55%. Next bar, next bar. They're the same event as far as I'm concerned. You go long, stop, go long, stop. You go short, 55% retracement of the green bar, stop above the high. 55% retracement of the green bar, stop above the high. Remember, 3 locations, at or near the 8, at or near the 20, at or near the 200. And if you get your 100%, you're adding to your long, adding to my long, adding to my short, adding to my short. Now, I want you to write this down, or at least make a mental note. When a stock, for me, if a stock is traveling above the 8-period moving average, and the 8-period moving average is rising above the 20, okay? I will add on every single red bar erasure. So think stock above the 8, 8 above the 20. Every time a green bar wipes out a red bar, I add. But it must be above the 8. Add the next time it happens. and it's traveling above the 8, it forms a red bar, next bar takes out the red bar, I'm adding. If that event happens above the 8, I will take every single one, and vice versa. I'm going to show you this on charts, but it's very, very powerful. All right, you can have a multiple bar pullback to your rising 8 or 20. You can have 4 bars, 5 bars. The number, as far as I'm concerned, does not count, right? Doesn't matter, all right? But you're stalking this stock. You see that the stock, the moving average, the 8 or 20 is rising, telling you we must go long, so I must wait for 55% of a red bar to get erased. Has that happened yet? On any one of these? We have gotten no retracement of a red bar yet. All right, what about now? Have we got 55% yet? No, but we're starting to salivate. All right? Corners of your mouth. But you do not wipe. Do not wipe. You trade first, you wipe second. We don't want to miss the trades here. All right? It's getting close. Now we've got 55% retracement. Bam, 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 bam. I'm drilling the longs, stop under the green bar. Drilling my longs, stop under the green bar. Now, this bar is small enough for me to wait for the 100%. If I'm starting to split hairs, the bar is too little to use 55%. This, I'm going to wait for the 100%, and I'm going to go in there. Little bars, 100%. Regular bars to wide range bars, 55. Bam. I'm adding here. I'm adding there. I'm entering for the first time there. Got it? Okay. So, stock up 8 rising, 20 rising. Stock pulling back. I'm stalking it. When is this 55% coming? 50, 30%, 33%, 55%. Boom, 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 boom. Stop under the low. Okay? 100% same bar, add. But the 8 and 20 tell you which way to jump on board, which direction to go in. If they're like this, you're long. If they're like this, you're short, whatever time frame you're playing. This is applicable on every time frame. I use it with my children's trust funds, long-term stuff. I use it on the 1 minute and everywhere in between. All right. I want you to look carefully here. This chart here. 20 is rising here. Where did you enter on this bar? First of all, what direction were you playing? Long or short? Long, right? 20 is rising. Okay? I'm not showing the 8. I should, but the 20 is rising here. So the stock opens, drops at the low. What color is this bar? Solid red. It's number 6. Right? When did you get in? At what retracement? Right there. Do you see that you bought right here in the bar? This green did not exist yet. This was open in a solid red right off the 20, 55%. Then what did you do when all the red disappeared? Added. Then it went green. And what did I say? If a solid red bar not only retraces 55, not only retraces 100, but then produces the opposite color green. What did I say about the low? The low forever. Wasn't quite forever, but I mean, this is a major low. You've got to assume that. Okay? Now, here's our move up. Now, look, we crash back to the downside. Okay? Let's assume you're stalking. You're waiting for a 55% event. When did you get one? Was this solid red at the low? Yes? 55%, enter, 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 stop below the low. This is at or near. You don't have to touch it. at or near the flat 200. Now, normally when you come to a flat 200, you will have crashed through your 8 and your 20. If you get the 55% at the flat 200 underneath, that's powerful too. Okay? Now, let's just take a look. We won't look at all of them here, but let's take a... I'm sorry?
You got in on that original trade, you got in on.
This one here?
Right. Where did you get out?
Oh, Oliver Velez has left the building up here. I mean, to be honest with you, with me, probably on this bar. I mean, this is a huge move up, but certainly on this bar, because what did this red bar do with that green bar? Wiped out the 55% retracement mark. Okay, I'm out. Okay. I am going to introduce to you some refinements on your stops, but I don't want to jump the gun too much yet. We'll talk about some refinements in just a bit. Here, look at this. Do I have a blown up version? Yeah, here it is. Look at I'm going to take this. This stock got back above the 20. The 20 is rising. Now, on a drop, you have to start stalking the stock. You're watching it. You're waiting. You can't do anything until it gets near one of your 3 locations. It's got to be near an 8, near 20, near 200. Now it gets, I'm going to blow it up for you. It gets near my 20. I want you to imagine this stock at the low was what? Solid red. Then you got the 55% retracement right there. You didn't get 100% retracement. So you didn't double up on this one. Okay? The next bar explodes. Now look at what happened here. That's a 55% retracement. And then the next bar takes out the low. Why here and not there? Right, there's your location. We're weeding out all of the events that don't happen at or near one of our 3 locations. Okay? Too premature, too premature. Okay. Let's get all these events here right near the 200, but let's focus on this event. Look carefully at the bar marked 3. Look carefully. Go over what happened. Think, the green did not exist at the low. The stock opened, dropped. At the low, it was solid red. It then, let me see if I have it. It opens, drops, solid red, erases 55% of the red, you enter, erases all of the red, you double up, then goes green. But when you have 55% of red, then 100, then green, that's the low forever. You've got to think that. That's very powerful. And there's your move to the upside. But that's how it looked before this. It opened, dropped. You're stalking the stock now. You know, you're salivating. It's near one of your locations. Now, it could keep going, but if it doesn't, if it gives you that retracement, 55, bam, 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 you're entering at the 55 with a stop under the low. And it happens, as you know. So you were in here, 55% of the red disappeared, and then all of the red disappeared, you added to the play. Notice your 20% of these will fail, guys. 80% will take you to the bank, 20% will fail on average. You're stalking the stock. It gets to the 8, this line is the 8, an event doesn't happen though. All right, crashes through the 8, comes toward the 20, 55% doesn't happen in one bar, the next bar gives you your 55% entry. And you're entering with a stop under the low, and there's your multiple bar rally. Yep.
Looking back about a few bars where you see that one about 3/4 of the way up, has that been an entry, or is it too far from the 20 and the 80?
This one?
A little bit farther back. Right, a little bit further up now, forward. Nope. Keep going to the right. There, that one. Right?
This one.
Yeah. Didn't that in effect almost do that? I mean, I know that you're subjecting this to interpretation, but is that...
Could you have taken an entry here? Yes, you could have. It's not precisely at one of our locations, but your moving averages are still tending to tell you that the bias is to the long side. And let me just say this. I am very relaxed about rules that, okay, these are the 3 locations. I tell my traders, I'm far more aggressive than most. I tell my traders, you can do anything you want to as long as you're disciplined enough to get out if it doesn't work. So as far as I'm concerned, when in doubt, get in. That's what stops are for. But you've got to be at a place where you can pull the trigger on this thing like it means absolutely nothing. And with these, the accuracy of these tactics is so high that I'd actually rather your approach be, well, let me get in and try it. Right? This is not quite it, but let me get in and try it. These are all just general guidelines. Here, take a look at this. We collapse, right? We're dropping, dropping, dropping. All right? This is too premature. We're now near we're near 2 of our 3 location items. All right? Look at this. We had a red bar at the low. We come off the low 55, the blue dashed line indicates where your first entry should have been. You could have doubled up because you got the 100%. Your stop's underneath the low. Okay? You just picked off the low. Right? Stock drops back at or near one of your location items. You get 55% retracement of a red bar at or near the 20. Bam. Stop below the low. That's the second low. Now, let's focus on the short side here for a second. Your declining 8 and 20 suggests that you can only take shorts, and you're only going to take shorts near an 8, near a declining 20, or near a flat overhead 200. We have a multi-bar run. You're stalking the run. You know you're going short. The question is, when does a 55% event happen and where? Okay? That's what we're looking for. This bar is small enough to actually forget about the 55. We need to enter on the 100. So nothing's happened, although we are getting excited. We're at our location or near it, and redness has started to eat through a former green bar. And on scenario 1 here, you've got a 55% retracement. I'm getting short with a stop above the high. I'm getting short with a stop above the high. I'm almost ready to go short, and I'm going short now, or once it cracked the low. Now, I'm adding to my short here. I'm adding to my short there. 100% on the same bar. All of this should be repetitive now. Now, here's your test. I want you to take a look at this chart and tell me, based on the moving average in the heart of the chart, are you a short seller or a buyer? Short, okay. And I've got one location item here, it's the 200. You're going to go short on a 55 or 100% retracement at or near this declining location item, the 20. So, which bar did you get short on between 1400 and 1430? Which bar did you get short? Isolate your entry bar. Identify it for me. That's right, the one with the arrow. That bar, you're in the short on this bar before that bar finished, right? Excellent. Which bar did you short between 1330 and 1400? That's the bar. Excellent, 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 excellent. Okay, fantastic. Now, if you held on to this short, at what point would you consider covering the short? Which bar? That one. That lost all of its redness, right? I would be gone. I want you to understand that the market is a breathing mechanism. It inhales and exhales, okay? The inhale point is the move back to the 20, and then it exhales away from the 20. It inhales and comes back toward the 20 or the 8, and then it exhales away from. The time to think about exiting is away from your key locations. If we're entering at or near the locations, you're thinking about exiting away from the locations. So, enter near my location on a 55 at 100%, exit on any trigger away from my locations. Enter near my location, exit in on any trigger. If you look carefully, this was red first. Then it lost all its red right there. Got it? That event happens away from my entry area, which is a sign to get out. Okay, let us get down to really serious business now. I'm going to teach you how to milk your winning plays for every dime, dollar, dead president. I like presidents, dead president. I mean, you know what I mean. I don't like dead presidents, but I like the bills that dead president. You get the point. All right. I love these. I love to be able to take a winning play and to make it count. Guys, this is what separates the big traders from the small traders. If you can't make your winning decisions produce enormous gains, then you can even be an accurate trader and still get nowhere. You've got to know how to make your winning plays win big. How many times have you experienced winning a lot, all right, losing once or twice, and being break even or down? You didn't let your winning plays really, you didn't maximize them. So that's one of the key separators of big traders and okay traders. You can be highly accurate, but if you do not let these winning plays really produce big wins, you're still in trouble. I use the 8-period moving average as my number one profit maximizing tool. And guys, if you get this down, you're going to be big, huge. This is the one thing I tell my traders, please work on perfecting this. It's the hardest thing to do. But if you get it right, your gains are going to be enormous. Here's the general guideline. If your long gets above a rising 8, you no longer control the trade. The 8-period moving average controls the trade. You stop looking at the bars. The bars mean nothing. If the stock is above the 8, step back. Let the 8 take you to the promised land. I call it taking the 8 train. If you're short and the stock drops below the 8, step back. Now the 8 will tell you when to cover. You will ignore the bars and just watch the 8. And only on a penetration of the 8-period moving average will you eliminate your trade. The 8-period moving average has this tendency to keep you in a winning play and help you filter out all the insignificant noise that usually knocks more inexperienced traders off a winning train. You got it? Now, every time you get a new event above the 8, add to your winning play. Every time a red bar gets wiped out above the 8, add to it. I don't care if this is the 15th time, add to it. Every time, but it must happen above the 8. So let's assume that you're in here because this little red bar got wiped out right near the 8. That's your first entry, let's assume. All right? Now, red bar gets wiped out near an 8. Add. Red bar gets wiped out by a green bar near the 8. Add. Red bar wiped out. Add. 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 Now let me tell you what a violation of the 8 is. A violation of the 8 is not a 1-bar poke through. You need 2 bars to violate, to have a violation count. 1-bar crack throughs do not count. So this looks like a violation of the 8, but it's a 1-bar peekaboo. What's going on down here? Right back up. You need 2 bars to actually have a valid break. Okay? So, if you had bought here, added here, added there, added there, added there, added there, you are in all of those longs. And you will do this as long as the stock travels above the 8. And you will liquidate your whole play on a violation of the 8. If you can do this, you're going to be huge. Sometimes your entry happens above the 8 and you start right away. Sometimes your entry is below the 8, then the play gets above the 8, then you step back. Got it? So sometimes you're actually entering and it's already above the 8. Sometimes it's below the 8, but once it gets above, it's like step back from the keyboard, put your hands behind your back, and don't do a thing until the 8 tells you to. Now, why is this so hard? My children get it right. Why don't adults get it right? Think about it. Every bar, your P&L's going like this. Wait a minute, is that a 55? Wait, is that? But it's above the 8. All right? Then it's like, whoa, oh, what? My P&L just went out. Whoa, should I take this? I mean, the last time I held on too long, I got wiped out. It's hard. Every tick is almost playing you. But if you can get in a mindset, it's just the 8. I'm just tracking the 8. If you get this right, it's going to be big. Do you know how long stocks stayed below the 8-period moving average the entire month of September? The entire month. And every time one green bar happened in the market, what did the next bar do? Crack the low. That's another short opportunity. Green bar wiped out under the 8, short. Drop more bars, then the market would have a sigh of relief, right? Oh, everybody's like, maybe this is the low. Then what did the next bar do? Crack the low. That's another short. Do you know how many green bars got wiped out under the declining 8-period moving average in Google and RIM and Adobe and all of the stocks? The market itself. September was an enormous month. October as well. Now let's take a look at this. Here's a chart. The gray is the 8-period moving average. The blue is the 20. The red's the 200. Now, what kind of bar does this represent? Neutral? Yeah, small, red, and where's the red? In the middle. You need the whole bar to be taken out, right? Now let's say you enter here. Off the 200, the whole bar gets wiped out. You enter here, stop below the low of the green bar. Okay? Now, this gets above the 8. You're already above the 8. Now, the rule is every time, a red bar gets retraced above the 8 you add. Where's your first addition? Right there. Right? That's right. Absolutely. Add to it. It's still above the 8. You do nothing. Where's your next add? Right there. Okay? Are you still in the play? Absolutely. Let me throw one more caveat out to you. I try my best to let the 8 train take me to the promised land. But if the stop traveling above the 8 all of a sudden does this, goes straight up and leaves the 8 in the dust, now I go back to the bars. Make sense? Away from your location item, far away, go back to the bars. Don't lose all of that all the way back down to your location. So you're going to ebb and flow. Sometimes you're going to go right back to tracking the bars. But when the 8 catches up, you're going to go back to the 8, let the 8 go. But if your stock leaves the 8, go back to the bars. If your 8 catches up, step back, let the 8 go. It's an ebb and flow. But don't now this has left the 8 behind. I'm stopped at the bars. Make sense? Too far away. This is a recent chart. This is October 8th. This is the entire month of September. This is Apple. You are below the 8. What did you do here? That's right. You're short right here because a green bar got wiped out under the 8. Short. You're still short because the 8's your trailing stop. The next time a green bar gets wiped out is there at, okay? Now you could take a 55% entry here, right? 55% of this green gets taken out. Okay? So you could add here, you could add at the 55% retracement level there. As long as the event happens under the 8, take it. Okay? Is that a violation of the 8?
Yeah.
No. You need 2 bars. 1 bar pokes don't count. Now let me explain to you what I mean by 2 bars. The bar that pokes through the moving average must have the next bar poke through the high of the bar that poked through the moving average. So in order for this to be a violation of the 8, this bar would have to take out the high of that bar. That's what I mean by a 2-bar break. The bar that pokes through must be followed by a bar that takes out the high of the bar that poked through. Now you've got a break. The reason why I put this 2-bar filter in because of this tendency. Because of this tendency. Look at that. Poke through, but go nowhere. All that is you ever see a boxer lean against the ropes? The ropes didn't break, did they? All right? This is leaning against the ropes. It didn't break. You need another bar to form the break. So, no break. Where is your next? Did you enter on this bar? I mean, I did. What about you? Yeah. I entered because this is a green bar, and this bar breaks the low, wipes out the green. It ended green. It dropped, then came back up, but I'm adding to the play here. All right, where's my stop? Because it's under the 8, it's the 8-period moving average. It's a violation of the 8. Okay?
Then go back to 5%.
Under the 8, what's your stop?
Oh, okay.
Right? The 8-period moving average. You ignore the bars when you're playing the 8. Okay? If it gets deep below the 8, go back to the bars. But if it's near the 8, forget the bars. It's the 8. This will keep you in plays. You have no idea how long you'll be kept in winning plays. It teaches you and trains you what ripples to ignore, which ripples to pay attention to. When do I focus on the bars and when do I stop focusing on the bars and just focus on the moving average? And you put all of this together, trading with the 8 and 20, whichever direction it says. Once your play gets above or below the 8, stepping back and adding on every event that happens above or under the 8, whether you're long or short, and you'll explode your profitability. You'll know which plays to actually keep making bigger and bigger and bigger. You'll know when to shrink down to the bars and not give it much room. That's away from your locations. You'll know when to ignore the bars and give the benefit of the doubt to the moving average that's near your locations.
Are you looking at multiple time frames when you're doing this, or are you just looking at one?
Good question. Am I looking at multiple time frames? Yes, I look at multiple time frames. And it depends on what type of trading you do. So let's say, for instance, you like to micro trade, the smaller time frames. I'd look at the 1, the 2, and the 5 minute. If that's a little too tight for you, then go 5, 15, 60. Then if that's a little too tight, go 60 daily, weekly. I use a 3-window thing. If that's a little too tight for you, go daily, weekly, monthly. So some traders say, well, Oliver, which window do I play? Well, which type of trade do you want? Do you want a trade that might last several months? Play the monthly. You want a trade that lasts several weeks? Play the weekly. Several days? Play the daily. I got tea time in like 20 minutes. Play the 1 minute or 2 minute chart. All right. Whatever type of trade you want, that's the time frame. But remember, you are not playing anything different by changing your time frame. If you change the way the chart looks on your computer, have you changed the market? It doesn't matter. It doesn't matter how your screen breaks up market activity. Doesn't matter to me. You can pick any time frame you want. Yes, sir.
When you say you're playing multiple time frames, do you mean you're trading in multiple time frames, or that you're using the information from one to manage your trade in another?
Okay, good question. Let me give you an idea of how I use multiple time frames. And this kind of gets beyond the scope of the subject, but you seem to be focused on it, and I think it's a good thing. I'll give you a general guideline. I go up time frame to get my directional bias. So for instance, I teach my traders, if you're trading smaller time frames, 2 minute, 5 minute, 1 minute, do not trade against the daily bar. So let me give you an example of this. If the daily bar is a solid green bar, that's bar number 1, right? Only go long on your 1, your 2, or your 5. Right? So the daily bar sets the direction. Now, make sure your 1, 2, or 5 have a rising what? 8 and 20, and now stalk. Get a 55% event and pile in. Get a 100% event, add. Right? Gets above the 8, step back. Some people say, Oliver, but which window? The 5, the 2, the 1. Well, which window does money show up on? I tell people all the time, does it matter what time frame? Does it matter? If you've got 3 windows in your house and you're going to stain glass all 3, but you only stain glassed 1 yet so far, and that's the most beautiful one. But someone throws a bag of hundreds through one that's not stained glass yet. That's the stained glass one's your favorite window. But will you not take that bag of hundreds? Of course. It doesn't matter which window. You get a 55% on a 1 minute, I take it. 5 minute, I take it. 2 minute, I take that one. Wherever it shows up. at any one of the 3 locations, right? To me, time is our creation. So it really doesn't matter. There's this notion that I don't like to trade in the smaller time frames, but it's the market. You've just made it smaller time frames. All right? I don't like to play the bigger time frames. It's the same. Wherever you want to draw your divisional lines on your screen, go ahead. All right? But these events will be real in every time frame. Now, how do you deal, if you're dealing with end-of-day time frames, how do you deal with the artificial stoppage of the market? The 4 o'clock Eastern bell stops trading. Then 9:30 in the morning we start. That's artificial. That's a man-made halt of the flow of supply and demand. So because of this artificial stop, stocks will immediately adjust in the form of a what the next morning sometimes? Gap. That's because we've held back. But if we didn't hold back the action, would it gap? No, it would trade there. So you want me to demystify gaps for you? Draw in the bar as if it traded where it's opening. Does that make sense? If a stock is gapping up $2, pretend like it didn't gap up $2. Pretend like it traded up $2. Did that trade up of $2 wipe out a red bar? If it did, that's a bullish gap. If the gap down, if you draw in the red bar as if it traded there, and that red bar wiped out a green bar right off of a flat 200, do you follow what I'm saying? You fill in the gap, and you'll get your answer, whether you play the gap long or short or what have you. Okay? But here, you're adding here, okay? Here's a 55% retracement of a green bar. You're adding there. Why you're adding? Because every one you're going to take if it's below the 8. Okay? And you're still short. Now, Apple has sensed, rallied right to the, crashed through the 8, rallied to the declining 20, and I don't have to tell you what happened. 55% retracement of a green bar, another short. Okay. Now, I took you from a daily chart. Now let me swing you all the way back to a 1 minute to show you that it doesn't matter. Just what type of trade do you want? I'm at a location item, 20. I wipe out a full small red bar. I'm in. Or, let's say I didn't catch this one. I'm in on this one. Stop. Okay? Now, once I get above the 8, I'm going to take every single one. Okay? 55% retracement. All right? 55% retracement. 55% retracement. 55% retracement. Gets way above the 8. All right? Go back to the bars. Now, can I throw one more thing out there for you? If the bar gets so incredibly tall that even 55% is ridiculous, go 33%. So when you lose a third, get out. But that's on a ridiculously long bar where it's even not intelligent to lose 55. Yes?
On that one where you took it back near the middle of the chart, now you can get like 5 green bars in a row.
This one?
Now, yeah, right here.
Okay.
Now, is that far enough from the 8 where you go to the bar?
You could. Yeah, I agree.
Determine if that's when you want to get out?
Yeah, I would not fault you as a trader for me who just said, I'm going to the bars now, so I'm out in this area.
Right.
But you better be back in.
Right. Oh, that's
Absolutely. Yes, you can. Absolutely. But see, it's definitely subjective. It's definitely subjective. What I do want you to do is always be quick to get in if your moving averages are still powerful. Okay? Because that's the number one key. Listen, You can't make the 8-period moving average rise. Otherwise, you wouldn't be here. Do you know what I mean? Do you know what it takes to make an 8-period moving? Do you know what it takes to make an 8-period and a 20-period moving average rise? Billions of dollars. So when you get a stock with the 8 and the 20 looking like that, and the stock is outpacing both of them, trust me, big giant institutions are just gobbling up and gobbling up and gobbling up. The only way to make money at this game, when you buy, what must happen after you buy? More buying. That's the only way you're going to make money. And it better not be just buying from your neighbors, right? It's got to be serious buying. So the way we detect serious buyers, 8 and 20 rising stock above the 8, that's serious. Because it takes a lot of buying, big buying, to create that scenario. And this comes down to just finding the elephant. See, the elephants, the big players, they wish they could step into the bathtub and not change the water level. They don't want anybody to see them. But they can't. If you know how to look, the water level rises. And when they leave, what happens to the water level? When an elephant steps out of the tub, the water level drops. So the moment, wow, an elephant just stepped in. How could you get a bar 6? That's the water level rising. All right? Water level rising. Water level rising. Water level rising. The elephants are stepping in. Does that make sense? But we jump on board their coattails and let them take us with them. Okay? All right. That was the 8-period moving average. And you know the next item is the 20-period. Sometimes you are going to violate that 8, and your next location is the 20. If you get a 55% event retracement there, you're going right back in. Okay? 100% retracement of the red near 20, you're going right back in. We've dropped away from the 20. We've drifted back toward the 20. Now I'm at one of my key locations. All I need is for a 55 or 100% retracement of a green bar, and I get it right there. Wipe out a green bar near the 20. There's my short. Are you still short? You've taken, somebody said, I've taken my money and run. Did I hear that? All right, it's okay. We are getting far away. Remember, as we move far away, you go back to the bars. If you were, I can guarantee you the 8 somewhere here. But if it has left the 8, you want to go right back to the bars. All right, now if the next bar takes out this red bar, I'm getting out. Why? Because that's happening away from my locations.
Just one thing back to the institutional buyers in the field. Should we assume then, if they're getting in and stock starts to increase a little, but then you have another huge entry for them, that they're dropping the price up so more
No. The question is, are you saying, don't assume manipulation, right? Does it happen? Yeah. But don't assume it. I think more people are hung up on that. They're more hung up than they should be, all right? It's really more just reading. It's really reading footprints, okay? It's really reading footprints. If there are more red bars than green bars on your chart, who's in control of the stock? Right? It's simple as that. If there are more green bars, they're in control. If you see that mix start to go from one side to now even, then to the other side, then the shift has occurred. Okay? The way I simplify that is just stick with stocks that rising 8, rising 20. declining 8, declining 20. And let me tell you this. If there is a powerful river that's traveling this way, some of you heard me say that. I mean, it's powerful. The current's this way. If you jump in, the current's going to take you that way. If you want to jump in, but not right at the moment, someone calls your name and you fall in, which way are you going to go? Does it really matter? If you pick the right current, you can make a mistake, trip, fall, mess it up a little bit, and you'll probably still be okay. You'll probably get where you want to go because you're picking the right current, 8 and 20. Yes, sir.
We're in 55, you go to 100.
Yep.
The line you're adding more. What are you getting out? Is it all in or out, and all out, or is it?
Well, it depends on your size. All right? If you've got 80,000 shares, you're not going to be able to get out at one price. But, yes, you're getting out as quickly as you possibly can. And sometimes it may have to be gradual if you play size.
But I'm saying it's not like getting in.
Right, no.
We're doubling and
Absolutely. You're getting out all at once. Absolutely. Yes, sir.
The previous chart, were you switching back and forth between the 8 and 20 day average strategy?
Well, here's, you can, but once, I'll tell you this, once I violate the 8, and then I get a reaction off the 20, to me that tells me the 8 now will be ignored. Does that make sense? It is now shifted down to my 20. So I'm going to not use the 8 as my trailing anymore, but I am going to look for multiple retests of the 20. What tends to happen is that once you get several successful bounces off the 8, if the 8 cracks, it shifts down to now having several successful bounces off the 20. And then if you crack the 20, if the 200's down there, that's where it's going.
don't like the
So we might have.
The 50? Well, if a stock can't get below its 8, if this stock can't get below its 8, and this stock is bouncing off its 20, which one's stronger? Stick with the strongest, right? Strongest currents. Yep.
We might have sold on the second red bar below the 8 and went back on the green bar above the 20.
That's possible. That's very possible. And I can take it even one step further for you guys. Every stock that I get stopped out of, I go back in on the very next 55 or 100% retracement. The very next one. That could actually wind up being on the same bar that stopped me out. So one bar can stop me out, and then if that bar has a 55, I'm right back in. Okay? If I'm playing with the moving averages. I don't let a little knock off the horse, if I've got the right horse, to stop me from making future money in it.
I am looking at the charts volume, and you have some blue bars.
Those are right where the blue bars are where the open and close are the same. Right? The open and close of the bar is the same, so it's blue. All right? Now, guys, look at the 200. You will get retests off of this is a very major location item, the 200 period simple moving average. If a stock is above the flat 200 and you get a 55 or 100% retracement of a red bar, all right, that's a golden opportunity to go long. Now, on this event, your 8 and 20 may be declining. That's okay. For the 200, if it's flat, you can ignore that part. All right? If it's a flat 200 and the stock is above it and gives you your 55% retracement event, you're in. Once you get above the 8, you can move right back to the 8. Could you have added here? You could have. It's above the 8, but yes, you can make a judgment saying, oh, it's a little too far above the 8. I'm not going to add. I'll miss that. I'll sidestep this one. That's okay. But what the pure traders on this approach do, they do it every time. as long as it's above the 8. That is a bit far. I agree. Now, where was your entry on the long side here? Right. This was a wide, long red bar, right? If you have a long red bar, and even 55 is too ridiculous, what's your percentage? I'm entering on a 33% retracement on this one. This bar was super long. This is now at or near the 55, but look at where my stop has to be. Too late. A third of the red gets erased, I'm entering stop. Now, what's your second entry if it gets there the first time, if your first was the 33? Your double down or double up spot becomes the what? 55. It's shifted down if you get on the same bar. Okay? Now I'm above the 8. If you switch to the 8, you can now add to the play on every red bar wipeout, as long as that happens above the 8. And you're still in this play. Powerful, powerful. And every now and then you get a mouth-watering event like this. First of all, here's a declining 20. Here's a wipeout of a green bar right near my location. Okay? But here's what I really want to point out to you. We rally right back to an overhead flat 200. The flatter the 200, the better. A little green bar means we've got to take out the whole green bar. This bar is the one that clears, the first one that clears an entire green bar. And there's your move to the downside. Beautiful. Now we'll probably be out somewhere here. What percentage is your entry off this flat 200? Excellent. You guys have got this. It's simple. Not easy, but it's simple. It's 3 percentages really. 33 for very wide range bars, 55, 100 in sync with the 8 and 20, or at or near a flat 200, and you're set for the rest of your life. You need nothing else. Nothing else. I can teach you more, but you really don't even need more. You can take this home. I mean, you can take this all the way to the finish line. I have traders making their entire living watching reds and greens disappear. This is it. All right, you are short on a 33% retracement here because you're at or near a flat 200. The 200 means if it's flat and you're at the 200, ignore the other moving averages in terms of a directional guide. Right? This is the only one where the 8 and 20 don't count anymore because it's flat and you're just going to play off the flat 200. Now, once you're flat, once you're short, once you get below the 8 period moving average should now be your trailing stop guide. Now, we're below the 8. Below the 8. What did you do here? Add it to the short there. Green bar gets taken out under the 8. Add to it. Okay? Now, is your stop the 8? Here? No, you move to the bars now. Because that bar is super long, what's your stop? What's your stop out? 33% of that bar. You guys have got it. This is the game. Over and over again. If you want a very hard life as a trader, if you want more stop outs than you can possibly count, if you want to lose money consistently, if you want migraines and to be stressed all the time, if you want that, there's some people who want that obviously, all right, then take most of your trades against the 8 and 20 period moving average. If you want an easier life as a trader, if you want to almost have to work at trades not working, to really, really royally mess it up for it not to work, if you want the vast majority of trades to be wins, even if you get small pieces of it wrong, then play with the 8 and 20 period moving average most of the time. All right? It'll be hard to get that one wrong. All right? By using the 8, you are ensuring of playing the strongest currents alive right now. If you use moving averages like the 50, that's a flatter move. But if a stock is traveling above the 8, you know elephants are stepping in, and they're stepping in big. We want to jump on board their coattails. Okay, now let's put everything together. This is your summary slide. It's simple. It's not 2 slides. It all fits on one. 55 and 100% retracements of current or former red bars at or near the rising 8. Boom, go long. If that event, 55 or 100% retracements of current or former LARs, happen at or near rising 20, go long. If it happens at or near flat 200, go long, and reverse. Apply in any time frame your little heart desires. Want a bigger trade? Go weekly. A monster trade? Go monthly. Okay. How I determine when at a drop of a market like we've experienced recently, I use monthly bars with these principles, and then I know when to start nibbling. Okay? I don't usually go in all at once. That's a novice approach. But if I will start looking for my bottom. If it's a big, giant monthly red bar, 33% off that, boom, I'm in. Okay? If it gets above the 8, now I start adding on every red bar wipeout. All the way. And in reverse.
On a monthly chart, what is an 8 moving average?
8 period moving average of 8 months, 8 bars. It's an 8 bar moving average, whichever time frame you're on. It'll just
Bar moving average, which means
the 8 bar average of the last 8 months closing prices. It's an 8 bar. So if this chart, right, is a monthly chart, it's going to average your last 8 months. That's going to represent the average closing price of the last 8 months. If that's a 5-minute, it's going to average the last closing prices of your 8 5-minute periods. It just averages the closing prices of whatever time frame you're on. Yes, sir.
if it goes from a monthly bar
Uh-huh. Yes.
for any of the indexes,
Yes.
I'm going to assume you're not even going to see the bar or the index or the 8-month line. You're going to be so far below it.
It's going to be below, which means if you're that far below, you're close to what?
Oh, you close? Oh, okay. Close.
You're right, because markets breathe in and out, right? If no living mechanism just has an exhale forever. So if you get far away from these key locations, you're close to a snapback of some kind. Okay, of some kind. And so
It'll take a volcano to tilt.
the 8, it'll take several bars to flatten it, all right? And then several bars to make it go up again.
So therefore, you're going to be betting against the trend.
Well, there are times when betting against a trend is intelligent. Remember what I told you? What I told you is that one of these scenarios I told you that you can go against the current trend is at or near flat 200. And then you can ignore what the 8 and 20 are telling you. The other times are on climactic moves so far away that you know that's an aberration. That's an aberration statistically over long periods of time. That is your exasperated final move statistically. So you can come near your location items, away. Come near, away, near, away. But then near and super far away is usually your last run. It's usually your last one.
You said you would jump on, you wouldn't nibble on.
No, I would start nibbling. I would start nibbling on a 33% retracement of a long red bar. All right? I would start nibbling on it. Okay? If it got above the 8, now I'm piling in on every red bar wipeout. Okay? Piling in on every red bar wipeout. Yes?
So, in putting all this together, would you still be looking at the tick and the trend?
The tick and the trend becomes somewhat unnecessary if you apply these concepts to the market itself. Okay? So if the entire market is below its 8-period moving average, you should be shorted. All right? Unless you get that exasperated move I told you about. So if you get on the entire market a 55% retracement of a red bar right off, let's say it's flat 200, you've probably got a decent low in the entire market. So when you start applying everything I've taught you to the indices, to your sectors, to your individual stocks, to all the time frames, why would you need anything else? I mean, those other indicators are just derivatives of what I've just taught you.
I have a question. At the beginning, you mentioned that all these are rules for a trending market. What about the flat market?
Okay, good question.
Trend all the time.
Right. These are, the question was, these obviously are, we've been talking about trending markets up or down, and there's always something trending. Okay? Always something trending. We make the most money in our trending markets. In flat markets, the way we specifically capitalize on them is we take the sideways zone, the zone, and the top third of the top, let's say 25% of the zone, and the bottom 25%, I want my triggers there. Make sense? So as you reach the extremities of your zone, your events become more reliable. The events in the middle of the zone are not as reliable. So it's that same thing. Away, snap back in, away, snap back in, away. This market breathes that way, whether it's on its back sideways, whether it's like this, or whether it's like that. It's always that breathing in and breathing out. And so we just take advantage of the ins and the outs. Ins and the outs. Yes, sir.
So you're looking at the 8 and the 20 for Apple.
Right.
Is market. Do you do any comparisons against like the broad market, like the S?
Sure. You can look at the SPY, let's say, all right, and say, listen, as long as this chart is under the 8, I'm going to be biased to the short side. It just makes everything clear, all right? Look, my S&Ps are below its 8, okay? Now, let me find stocks in the S&P below their 8. And now that I've got stocks that are in the S&P below the 8, just like the S&P, let me wait for 55% retracements at or near their declining moving averages. It's simple. And so now you're playing in sync with the market, in sync with the stocks. Is this all making sense, guys? Yes? No? Okay.
How do I differentiate between opportunities? In other words, I can find X amount of stocks following,
Yes.
okay, but I only have X amount of money. So the question is, which ones do I do?
You come to me and I'll give you money to do this, all right?
The whole course.
I just can't be everywhere. This whole thing came into existence because I can't catch every opportunity. But if I do catch it, I know what I will do. So if I teach you to do it and then give you money to do it, we miss nothing. All right? Well, I want to take over the world. No. But how do you take advantage? First of all, I find that most traders focus on too large a list of stocks. They're trying to be everywhere at the same time, which means the bigger your list, the more opportunity you're going to miss. When a New York Stock Exchange specialist is hired, how many stocks does he get? One. NASDAQ market maker, maybe 2 or 3. These are the gods, and they are very specialized. We're not the gods. So we should actually we should be closer to that approach than I'm going to look at 500 stocks. Okay? Because see, when you step into their world, you are going to have a hard time if you are unfamiliar and they live every moment of that stock. You walk into their life, their world, and walk up to their table, and they play every ebb and flow and every tick. You have zero chance. Okay? So you should have a small list of stocks, all right, that are your go-to stocks. These stocks should be so familiar to you that when someone in a crowd mentions the symbol or the name, you will know what the last low was last month, where it was. It should be that familiar. You should be so familiar with your stocks that when they're about to move, they tell you. All right? It should be just like that. So what is that? I'd say 8 stocks. Now, your list that you track can be longer, but the stocks you pay the most attention to, the stocks you take the most trades on, should be about around 8. That's my general guideline for my traders. Okay? And this way, it's familiar. The idiosyncrasies of the stocks, how it trades, the players, the tricks, the games that are done in them, you're all familiar with that. Powerful. So guys, for those of you who are interested, I need you to give me a few moments to explain to you, for those of you who are interested, how to become one of our traders, if that is your desire. But let me just tell you this. If it is not, I want you starting Monday to at least start tracking these events, and please try to use them. I would start Monday. They're going to benefit you for the rest of your life. These are not events that stop working. These are not events that disappear. I know traders who made all of their money taking the spread out of stocks. When I first started trading, the average spread in the NASDAQ stock was $1.75. So the way to make money was to just say $1.75, well, I'll make the spread $1 and take the dollar away from the market maker. But that game disappeared because spreads now are what? A penny. No, they're fractions. We trade in between pennies now. That game disappeared. This game will never disappear. This is not something that's an anomaly and that will go away 10 years from now. All right, so please use this, whether you have an interest in becoming one of my traders or not. If you do have an interest, I want to tell you how this works. Our program is a program for life. There is a cost to it up front, but the entire cost is given back to you. Okay? For the lifelong master trader program, it's about $10,000. It's $9,000 if you sign up by a certain date prior to the event. You pay one fee for the rest of your life. You will never be asked to pay another dime for anything. You will be funded for life. Your losses will be absorbed forever. As long as you want to give it a shot, we will work with you and fund you and take your losses forever if it has to be. But understand, I will not allow you to lose a lot of money. It just simply will not happen. And we will do this until it works. Every single service I provide, every newsletter I write, every chat room I have is yours free for the rest of your life. This is not a program where there's, okay, now that you have this program, you need the super duper program. And what about the platinum package? None of that. One fee forever. And get this, you pay it once, and as we make you profitable, right, you gradually get the entire fee back with your profits. Every $12,000 you make, you get a $2,000 bonus check back. Another $12,000, $2,000 back until your entire training fee has been completely recouped. This is not just a 7-day training program. The initial training to start is 7 days. Your training is forever. As long as you have my money in your hands, You are going to be worked with every day you want to be worked with. You're going to be mentored every single day. You're going to be assigned to some of the top traders in the organization. They are going to help you with your trades. They will have an incentive to do so because they get a percentage of the profits. You're going to be worked with forever. All right? I have 1,400 traders worldwide who are part of this program. And we've had one of the most explosive growths in trading history as far as a private equity firm. All right? This 7 days is comprised of two components. Remember I told you we've got education up the wazoo in this industry. We don't have professional training like we should in this industry. But the 2 days of it is the educational part. It's what we've done here. You will sit down with me. We will go over every single tactic that we use to pull money out of the markets. It'll only take me 2 days to do that. 2 days. There will be no need for a third day because you get everything that we do inside of 2 days. But that is theory. Once you complete those 2 days, you will not know how to trade. You will not know how to do it, but you'll know what it is from a theoretical point of view. Too many people in this industry think that you can learn how to trade by sitting in a hotel room reading a nice, beautiful color book. It doesn't work that way, not even my 2-day seminar. You don't emerge after 2 days as a trader. But the next part becomes extraordinarily important. It's the 5-day portion where we take everything we've covered in theory. I put $50,000 in your account, and from Monday through Friday, we trade these things live hundreds and hundreds of times. Every day you will do 300 to 500 trades. By Friday, trades will be coming out of your ears. You will have this so down and pat by Friday. You will have traded more times than most people trade in a lifetime inside of 1 week. And you will experience firsthand how accurate this is. All right? Powerful. Now, those of you who can't do 7 days all at once, you're breaking it up. 2 day first, all right? And then 5 days. 95% of the people take the 7 days straight through. Now get this, guys. I used to pick and choose which students got selected. I do not do that anymore. Every graduate of the initial 7 days gets funded for life. I've stopped the selection process. I'm not good at it. I've seen people that I thought would never make it in a million years make it. And I've seen people that I thought would make it, never make it. So it gives everybody the chance across the board. Now, a lot of people say, Oliver, how can you do this? How can you constantly fund people coming in every month, these dollar amounts and yada, yada, yada? And how can you do it? How does it work? It's simple mathematics. If I only allow you to lose $90 in a day, that's your cutoff. And I've got traders making $15, $18, $8, $6, $3,000 a day. That makes up for a lot of $90 losses, doesn't it? So my whole trading team is handled the way you should handle all of your trades. Your winning trades should be much bigger than your losing trades. And if you really get it right, your winning trades, your bigger winning trades will outnumber your losing them trades. So as long as I've got traders making in the thousands per day, while you're losing $90, $60, $200, $100, I can do this forever. And the math works. So that is why I tell you, I cannot allow you to lose big money because it would mess the ratio up and turn this whole system into a losing proposition for me. And let me tell you this. I told you there are 212 educational firms in America that claim to be able to teach you how to do this well. One question I beg it to be asked. One question. If your education is so great and I'm going to be so wonderful after it, can I use your money first to try it out? How many firms are that confident in their education? I'm going to back you for the rest of your life. Now, here, again, 100% refund of the fee. Every $12,000, you get a $2,000 check. So ultimately, the program is for free. Some traders, well, let me just say this. 22 years ago, I made up my mind that I found what I wanted to do for the rest of my life. And I made up my mind that I would trade until I died. The last day of my life, I will have placed a trade. That's the attitude I took. So that then what that attitude did was make every individual trade not that important, which I think is important to have that attitude. If you're going to trade for the rest of your life, what does it matter? How important is the result of this single trade? If it's one trade in millions of trades you'll make over your life, not very much at all. And that creates a state of non-fear. If you're going to be part of this program for life and will never have to use your money, all right, then ultimately this fee is yours back. So, I'm not a complete idiot. We will be partners, okay? All right? We will share. If I work on you and I get you consistently profitable, we then become partners in your profits. My money, my risk, our profits. And the way that works is you get you start off getting 60% of the gains, I take 40% of the gains. As you reach certain levels, you get 65, I get 35. Then you get 70, I get 30. All the way up to my top traders are getting 95% of the profits. I'm willing to take a small piece of the profits if the pie is enormous. Okay? That's how this works. I will say this. Many trading firms in the industry have a golden handcuff scenario to their operation, which means that when you get paid once a month, okay? What the golden handcuff scenario does is they pay you half of what you're owed, then the 50% that's held back, they split it up. 25% will come to you 6 months from now. The other 25% will come 18 months from now. So that as you become more and more and more and more profitable, your arrearage gets bigger and bigger and bigger. But here's the thing. In their contracts, if you leave them, guess whose money that is? Theirs. So there are traders in these scenarios that, Oliver, I would love to come trade you, but I got $4 million coming to me, man. And I can't get them and they can't move over. We don't have that scenario. There are no golden handcuff scenario. You can walk away anytime you like, but I'm willing to bet you won't. 1,400 traders. I've lost 6 traders. Not because they got eliminated, because they said, Oliver, I've just realized this is not for me. All right, if you're interested, guys, all of my educational work has been rated #1 by almost everyone out there. Been on CNBC, Forbes rated me #1, Barron's, Dow Jones called me the Messiah of trading, or what have you. If you're interested, this is in your book. These are the contacts. Every person you speak to, if you have more questions, they are one of my traders. Not a salesperson, one of my traders. That's the email address if you're interested in just writing some of your questions. And if you're interested in some of the upcoming events, we do this online and on site. Remember, guys, it doesn't matter. Some people say, Oliver, I just like online or I just like on site. It's all yours. One fee, and you take as many events as you want to. All right? It's one fee for the rest of your life. Okay? November events are posted in your book. Okay? December events are posted in your book. Every single on-site event sells out. I have to turn away people every event. Online, of course, is limitless. Okay? Any questions?
What's the advantage of being on site as opposed to being online?
Well, my face? There's really very little difference. I will tell you that some people regard on-site a little less convenient sometimes because if they happen to get the chair behind the pole, and you follow what I'm saying? But the on-site, the most important part of this is your trading, the trading live, which I can do with you on-site. On-site, my screen is on a screen like that, and you're following every single one of my trades. We're living them live, hundreds and hundreds of them. And we're doing the same thing, putting you on my back and showing you how this works. And it'll start to feel right to you. Now, online, your screen becomes my screen. It's the same. It really is the same. But here's what you do. You're going to take onlines and on-sites. They're all yours. Okay? They're all yours. Again, don't forget about the 100% refund. And you have been a phenomenal group. All right? Thank you very much.